900 million barrels of oil gone from the market, not destroyed, not consumed, just locked inside a waterway 33 kilometers wide that the world's most powerful military cannot fully reopen. The number being quoted in headlines is 170 million barrels, the crude sitting on 166 tankers anchored in the Gulf, waiting. But that figure is only what's visible above the surface. Analysts at Kpler estimate the total energy sidelined by this crisis is closer to 900 million barrels, and it is growing by 200 million barrels every single month the Strait of Hormuz stays closed. The question Wall Street is pretending not to ask is the most important question of 2026. Who is actually paying for this? On February 2026, the United States and Israel launched coordinated airstrikes on Iran, targeting military facilities, nuclear sites, and leadership. The operation killed Supreme Leader Ali Khamenei. Within days, Iran's response rewrote the rules of global energy. The IRGC laid naval mines across the Strait of Hormuz, boarded commercial vessels, and issued a declaration that effectively said, "Nothing passes unless we allow it." Before that day, the Strait of Hormuz was the single most important choke point in the global economy, one corridor 33 kilometers wide at its narrowest. Through it flowed 25% of the world's seaborne oil trade and 20% of all liquefied natural gas. Before February 28th, an average of 120 ships transited it every single day. Today, that number is 4. The economic actors in this story are not just Trump, Netanyahu, and Iranian commanders. They are every refinery, every airline, every shipping company, every farmer, and every American household that fills up a tank. Let's start with the number that changes everything. Gulf states and Iraq are losing approximately $1.1 billion per day in oil revenue while the strait remains closed. That is not a projection. That is what the Dallas Federal Reserve's Research Division calculated in March 2026, and it compounds every morning the sun rises over the Gulf of Oman with no resolution in sight. Over the first 67 days since the closure began, that number approaches $74 billion in lost regional revenue. This is the headline figure. But the headline figure is not where the real story lives. Because here is what most analysts missed. The countries losing that $1.1 billion per day are not the ones paying for it at the other end. The bill for Hormuz is not being sent to Riyadh or Abu Dhabi. It is being passed forward through supply chains, through futures markets, through the pump price at your local gas station, to the American consumer. In January 2026, Brent crude was trading at $61 per barrel. By early March, it crossed $100 for the first time in 4 years. By its peak, Brent had hit $126, a doubling in less than 45 days. That is a rate of price increase faster than during the Gulf War, faster than during the Ukraine invasion, faster than any single supply disruption in modern history. The Dallas Fed's own models quantify the transmission. A closure that removes 20% of global oil supply lowers global real GDP growth by an annualized 2.9 percentage points in the second quarter of 2026 alone. If the strait remains closed for 3 quarters, and right now there is no credible plan to reopen it, the model implies a 1.3 percentage point reduction in global GDP growth for the full year. Now here is where the money trail gets interesting. The financial winners are not where you would expect them. The obvious winner is the U.S. domestic energy sector, and the numbers confirm it. Energy stocks are up 40% year-to-date in 2026, the top-performing sector in the entire S&P 500. Companies like ExxonMobil and ConocoPhillips are printing cash every single day the strait stays shut because their production, based primarily in Texas, North Dakota, and the Gulf of Mexico, faces no disruption whatsoever. Their costs are fixed. Their revenues are indexed to a global oil price that has nearly doubled. The spread between what it costs them to extract a barrel and what the market pays for it is the largest it has been in years. But there is a less obvious winner that mainstream financial media has almost entirely ignored: Oman. A small Gulf state with one critical geographic advantage, virtually all of its export infrastructure lies outside the Strait of Hormuz. While Saudi Arabia, the UAE, Kuwait, Qatar, and Iraq are hemorrhaging oil revenue, Oman is selling crude at $100+ per barrel without restriction and without risk. The Baker Institute at Rice University explicitly identified Oman as the one Gulf exporter earning windfall profits from this war. That is not a coincidence. That is geography as financial strategy. The financial losers are a longer list, and the damage is more structural than the market has yet priced. airlines are facing a catastrophic cost shock. Jet fuel represents roughly 25 to 25% of an airline's total operating costs under normal conditions. When Brent crude doubles, that percentage climbs toward 40%. American, Delta, and United have all seen their share prices trade under pressure, even as the broader S&P 500 hit record highs. The divergence is the market telling you, AI is fine, tech is fine, but anything that burns fuel is bleeding. And this is where the supply chain angle gets deeply uncomfortable. The Strait of Hormuz is not just an oil route. It carries 22% of global LNG supply, primarily from Qatar. On March 18th, an Iranian drone strike hit the Ras Laffan LNG facility, taking approximately 17% of Qatar's gas export capacity offline. Europe, which spent 3 years after 2022 frantically building LNG infrastructure to replace Russian gas, now finds its replacement supply under attack. European natural gas prices have spiked accordingly. But here is the number that has not yet made it into the American news cycle. Roughly 30% of internationally traded fertilizers, urea, ammonia, normally transit the Strait of Hormuz. When those fertilizer shipments stop, the price of growing food goes up, not next year, now. The Fertilizer Institute reported in March 2026 that nearly 50% of global urea exports originate from countries west of the strait. Urea is the most common nitrogen fertilizer used by American farmers. When input costs for U.S. agriculture spike, food prices follow, with a lag of roughly 3 to 6 months. The Hormuz crisis began in late February. That lag puts the full food price transmission arriving in American grocery stores sometime between August and October 2026. The bond market has not priced this, consumer discretionary stocks have not priced this, and most retail investors have not priced this. Here's the non-obvious financial connection that ties everything together. The U.S. government knew before February 28 that this closure was possible. The Joint Chiefs of Staff warned President Trump in pre-war briefings that Iran might close the strait in retaliation. Trump acknowledged the warnings and dismissed them. What that means financially is that the 400 million barrels released from IEA emergency reserves in March, which represented roughly 4 days of global consumption, was the pre-planned emergency response, 4 days of buffer to cover a crisis that is now approaching its 10th week. The reserve release bought time. It did not solve the structural shortfall of 15.8 million barrels per day that remains locked in the Gulf. The investment implication is this: the market is currently pricing a resolution. Futures contracts for Brent crude delivery 6 months forward are trading below spot. The market believes this gets fixed. But every day the strait stays closed, the physical inventory deficit widens. The gap between what futures say oil is worth and what buyers are actually paying for delivered crude, what traders call the spot premium, has reached levels with no direct historical precedent. The moment the market stops believing in a resolution timeline, that futures curve inverts violently. And when that happens, every asset that has been quietly ignoring this crisis, consumer staples, airlines, emerging market bonds, and USD-denominated debt held by energy importing nations, reprices simultaneously. That is not a prediction. That is what the data already says. The market just hasn't looked at it yet. The Strait of Hormuz remains effectively closed as of today. A deal may be close. Rumors moved oil 8% in a single session just hours ago. But 900 million barrels of stranded energy does not flow back into the market the moment a ceasefire is signed. Kpler's analysts estimate it could take up to 3 months just to clear the backlog once the strait fully reopens. 3 more months of tightening physical inventory, 3 more months of fertilizer disruption, 3 more months of jet fuel burning through airline margins. The political resolution, when it comes, will dominate the front page. But the financial consequences, the food prices, the GDP revision, the sovereign debt stress in energy importing nations will keep running long after the headlines move on. The question is not whether a deal gets done. The question is, by the time the strait opens, how much of the damage is already permanent?